This is Dr. Pete with TradeRounds. Both Ben and I have been on extended vacations during the month in July, so I thought I'd give you a little bonus material in lieu of some shorter videos that we usually put out for you. We're going to do something nice here where I look at the technical health of the stock market from a variety of perspectives. This is something we would have typically offered premium members in the past. So to start off with, we're looking at the price of copper. Copper is often called Dr. Copper for its apparent predictive value for the economy. We've reviewed this recently as well, and you can see during the bit of slowdown leading into the 2016 election, the price of copper went down around $2, stabilized for a while, and then in the subsequent bull market with improvement in GDP growth, we've seen copper move higher up above $3. Now what's interesting, despite all the recent positive news regarding economic growth and unemployment, we've seen copper come back and test this area here, which isn't uncommon in commodities, which tend to be quite volatile. But this is definitely a significant move down from 330 to 270, and we'll see if this level holds. I would become a little bit more worried about the economy if we break down below this level. The VIX is sometimes referred to as the fear indicator. It is related to stock options. And basically what we can see when volatility increases and there's fear in the stock market, the VIX tends to explode as it did in early February, a bounce again in late March, and then a little bit in June it looked like we might be headed for some trouble, and then things settled down a bit. And one thing you do notice on this chart repeatedly that I think merits caution is if you look around this $10, $11, $12 level, bottom here, bottom here, bottom here, bottom here, here, and now here. And then look at this wide-ranging bar here from Friday that engulfs the prior day. And I just have a little hunch we're headed towards a little more volatility, such as what we saw on Friday. So this actually is a measure of when it's cheap to buy insurance on your portfolio or to hedge, and that would have been the last few weeks. It's better to try to hedge your portfolio when things are calm and looking good, whereas everyone scrambles for protection when the market is already declaring itself as volatile and more dangerous. Now this is HYG, which is the exchange traded fund for high yield bonds. The bond and institutional bond guys, I should say, are generally considered the smart money in the marketplace, and so sometimes by looking at high yield we can get some sense of where stocks are headed, and one can see this sort of mild uptrend with a little bit of volatility built in. We recently broke out to a new recent high of the last 6 months here in late July, and it will be important to see if this holds up or is merely upthrusting this area. If more volatility comes into the stock market, we would certainly think that this would head back down. But there's nothing specifically here that gives us any sort of leading indication that high yield debt is in trouble. So another one of the indicators I like to look at for market health is a variety of market breadth indicators. This is the percentage of New York Stock Exchange stocks above their 200-day moving average. The indicator is in red and black, and then there's various moving averages that I use sort of as a smoothing effect for this. And we can see a decline in this indicator starting in February where it went below all the various moving averages that I follow. And so around here you knew the market was in a bit of trouble. We bottomed in April, and we've had a steady rise since then, a little bit of a downturn in market breadth in June, where I actually mentioned on our Facebook page and elsewhere that I was quite concerned about the relative health of the market, but we recovered at least, albeit till this week. And we're okay at the moment in July, but I think with all these moving averages, this is the 7, the 150, and the 20 converging. The position of the indicator relative to this, if it goes below and holds for several days, I think you have a good signal to be careful after this move up from the bottom. On the other hand, if we see the indicator curl back up and stay above these three, I think we could have several good weeks of positive market action. So I think this indicator will be quite helpful over the next week or so. Now this is a somewhat shorter term indicator on the same theme. It's the New York Stock Exchange percent of stocks above their 50-day moving averages. We can actually see on this chart the S&P 500 graphed up above the indicator. And you see sort of the same picture you saw with the percent of stocks above the 200-day moving average. Here we've actually crossed below the 7-day and the 20-day, which perhaps could suggest some short-term trouble. And I would watch to see if the 150-day the 150-day moving average here holds. If this goes down below this again, I think I would be cautious. We do see, if we draw a trend line on the stock market, at their peaks since April, we're sort of in an overbought position where we might expect a little bit of a correction even if we're going higher in the long term, but that remains to be seen. Without going into the details, this is the Bullish percent index, which is another measure of breadth. It's plotted on a special type of chart that we teach called a point and figure chart. Generally, what you like to look for best buying opportunities in the stock market is seeing that this indicator is oversold down below 30 and then breaks into a column of X's where it exceeds the prior column of X's. So in other words, right around here would have been a good buy point in sort of early mid 2016. And then around February or so, we saw the indicator break down below this level, and a good time to sit on your hands perhaps and watch this recover. We've recently broken back to the upside with this indicator. This is a somewhat slower moving indicator, and this gives you a bit of a longer term many month view. For right now, it seems to suggest that the market is okay in the longer term, even if we undergo some short term volatility. Now, perhaps my favorite of the market breadth indicators is the S&P Bullish Percent Index, S&P 500 Bullish Percent Index, graphed against its 32-day exponential moving average. So here we see the indicator again in red and black with the 32-day moving average here. We can see that this cut below and held for a few days in early February, suggesting that it was time to be careful, which indeed was the case in the first few months of the year. Now, what I like to do is look and see the indicator hold for a few days. We had a little bit of a false signal here, and yet if you watch for a few days, you knew to stay out still till early April, and then we crossed again. Maybe a little bit of false signaling here, but again, you have to look at the market overall technically in combination with this indicator. And it's been pretty smooth sailing since May, albeit with one cross here for a few days. And this indicator still looks healthy. Finally, just to look at the stock market on a bit of a longer term basis, this is a monthly chart of the S&P 500. Here you see the 2009 bottom, and basically a relatively strong uptrend for the last 9 years, which is a pretty long bull market. We can see that pullbacks have conditioned people to be buying in large amounts. You can see volume coming here, buying volume coming in here, and perhaps less so here. We've had a really nice move up since the election of 2016 until earlier this year. But you can see in the overall picture, as bad as February and March may have felt, if you looked in a longer time frame, this really was a small blip in the ocean compared to volatility around the European debt crisis, etc. It seems for now that despite some volume coming in here where we tried to go lower, the market still seems to be leaning higher in the long term, and the market is by no means technically broken. This is RSI 14, which certainly shows when it's in green that you have an overbought market, and yet markets that are in an uptrend when they are overbought can continue to go up for quite some time. We see that in early 2013 where the market remained overbought almost all the way through into 2015, and you can see the nice move in the stock market during that time. We've been overbought since the beginning of 2017 and barely broke beneath the overbought level of 70, and the market's pretty much gone up continuously except for that blip in February. So as bad as Friday may have felt and looked in many ways, the longer term picture has not gone negative yet. That is not because I know where the market will be in 6 to 12 months. It's just there's not a lot of technical indication at this point that you need to seek cover. So I hope you find this helpful. We'll be posting more stuff this week now that we're back off vacation, and we thank you for your patience. Have a good week.